The biggest challenge for any trader, I think, is figuring out how to spot those really big market moves before they actually happen. Well, today we're going to break down a powerful strategy that's designed to do exactly that.
Oh man, we have all been there. You pull up a chart, you see this massive spike up or this huge drop, and you just think, wow, I missed it again. It's frustrating. It feels like if you could just find these key turning points ahead of time, everything would click.
And that right there is the secret sauce. This isn't about some crystal ball or just pure guesswork. It's about using a specific technique that gives you this incredible head start. It's like instead of just swinging wildly at every pitch, you're stepping up to the plate with the bases already loaded. You have a massive advantage before the trade even begins.
So here's the game plan for today. First, we're going to decode what the market is actually trying to tell you. Then, we'll get practical and learn how to draw our battle lines on the chart. After that, we dive into the actual trading tactics, cover how to master your risk, which is crucial, and finally, we'll pull it all together to show you the incredible mathematical edge this strategy gives you.
All right, first things first. Before we can even think about drawing lines, we have to understand the why. What is a chart really showing us? What's the story it's telling?
At its very core, every chart is just a story about the constant tug-of-war between supply and demand. And these support and resistance levels, they're like the key chapters in that story. They show us, right there on the screen, where the power is shifting between the buyers and the sellers. It's not random squiggles, it's a map of market psychology.
And it really boils down to this simple balance. When there are more buyers than sellers, when demand is greater than supply, the buyers are in charge and the price naturally trends up. On the flip side, when there's more for sale than people want to buy, the sellers take over and the price heads down. The levels we're about to find are just the visual proof of where these shifts in control happen.
Okay, so we get the theory, right? Supply and demand. But how do we actually find these levels and get them onto our charts? Let's get our hands dirty. It's a surprisingly simple three-step process. Seriously. First, you just kind of zoom out and look at the chart. What's the general direction? Is it moving up or is it heading down? Easy enough. Then you just grab the trend line tool that's in pretty much every charting platform. And finally, you just connect the dots. If it's an uptrend, you connect at least two of the major bottoms, the dips. If it's a downtrend, you connect at least two of the major tops, or the peaks. And that's it. That's your baseline.
Now that our lines are on the chart, this is where the fun really begins. They stop being just lines, and they become our map. This is how we go from just looking at the past to actually planning our next move based on what the price does next.
So check this out. When the price approaches one of your trend lines, one of two things is probably going to happen. Scenario 1 is the bounce. The price hits the line, respects it, and continues on in the same direction. Scenario 2 is the break. The price just blows right through the line, which is a huge signal that the old trend could be over and a new one is about to begin. The cool part is, both of these events can be a trading opportunity.
This leads us to a really specific and powerful technique for finding great trade setups, especially after a trend has been broken. It's a simple little rule you can remember. We're going to use points 1, 2, and 3 to anticipate where a potential point 4 might show up. This gives us a really clear zone to watch for an entry. Okay, let's walk through this together. So after an old trend breaks, you start looking for a new pattern to emerge. You see that first peak? That's point 1. The very next bottom is point 2. And the next peak after that, that's point 3. Now you grab your parallel channel tool. You click on the high of point 1, connect it to the high of point 3, and then you just drag that whole channel down so the bottom line touches the low of point 2. And right there, that bottom line of the channel becomes your target zone. That's your anticipated point 4. Now, this next part is absolutely crucial. Finding a great-looking entry point is one thing, but what separates the pros from the amateurs is always risk management. How do you make sure that if you're wrong, and you will be wrong sometimes, you don't get blown up? Just look at how beautifully this is structured. Your entry is super precise, right there near that point 4 we talked about. Your stop loss, your safety net, goes just a little bit outside the channel. This is so important. It means if the price breaks that channel, your idea was wrong. Simple as that. And you get out with a small, manageable loss. But look at the take profit. It's open-ended. Let that sink in. Your potential loss is strictly defined and small, but your potential profit is unlimited.
So what happens when a trade actually goes your way? You don't just sit there, you manage it. As the price moves in your favor and makes a new high and then pulls back a little to form a higher low, you slide your stop loss up to right underneath that new low. At that very moment, you can't lose money on the trade anymore. Your risk is officially zero. You've locked in some profit, and now you can just let that winner run, trailing your stop up as the trend keeps going.
And all of this, it leads us to the most powerful concept in all of trading. When you can combine these precise entries with really strict risk management and let your winners run, you create what's called an asymmetric advantage, a massive mathematical edge that works in your favor over time.
This is what asymmetry looks like. For every, say, $100 you risk on a trade, that's the absolute most you can lose if you're wrong. Your potential reward isn't capped at $100. It could be $580 or even way more. The whole idea is that your potential reward should always be a multiple of your initial risk.
I want you to really let that sink in for a second. With this kind of setup, you don't need to be right all the time. You don't even need to be right half the time. You can literally be wrong and wrong again and wrong again, 6 trades in a row, and then one single winning trade can come along and wipe out all those small losses and put you right back at break even, or maybe even ahead. That just completely changes the psychology of trading, doesn't it?
And listen, this isn't just some abstract theory. This is a real example from the source material. A trader took these exact ideas, put them into practice, and on one single trade, they made 34 times what they initially risked. That just shows you the incredible power of this approach when everything lines up.
So, what's the big takeaway here? It's that these patterns on a chart aren't just random noise. They're the footprints of supply and demand. And by learning how to read them, how to draw your lines, and most importantly, how to manage your risk around them, you put the odds in your favor to catch some really big moves. So the only question left is, what are you going to find on your chart?